Hey guys, Joseph Henson here with Henson CPA Group, and we've been going through some cash flow stuff. Today we want to go ahead and talk about EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. So we will go ahead and dive in to understanding EBITDA in your veterinary practices. Again, I'm Joseph Henson with Henson CPA Group. I'm glad you guys are here this week, but we had a lot to go through, so I'm just going to go ahead and jump right into it. So what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It measures a business's core profitability and is often used to evaluate financial performance without the impact of financing and accounting decisions. Accounting jargon for, hey, if it doesn't have to do with your operations, it probably shouldn't be included on here. And with that, you have interest. If you're paying interest expense, not truly an operational expense, it's a finance expense a lot of times. Taxes, it's the same kind of thing. If you are an S Corp, which a lot of veterinary clinics are, you probably have the pass-through entity tax that you're paying to New York, Missouri, Chicago, California, you name it. But that's something that shouldn't really affect the operating expenses of the clinic. Depreciation and amortization, these are going to be on your tax return, and they are non-cash transactions. So that's kind of what it really means, and that's how it affects you. So why does EBITDA matter for the vet clinics? It will give you a clearer picture of operational profitability. You can have a lot of income on the books and a lot of expenses on the books that don't truly affect your operating efficiency. You don't want to take these into account when you're saying, how efficient are we with our clinic? Because these typically will just drag your profitability down. If you're paying taxes at the entity level that are passing through to the shareholder, this isn't something that would typically affect your operating capabilities. They're going to be commonly used by buyers and investors to value the veterinary practice. If you are looking to sell, a lot of investors, a lot of corporations want to do that on a multiple of EBITDA. And it helps you understand what your business is truly earning at its core. What work you are putting in and the direct expenses related to that work is what your operating profit should be. How do you calculate EBITDA? You want to start with your net income. This is the very bottom line. And you want to add back any interest expense, any taxes, depreciation, and amortization. These are the ways that you get to EBITDA. So an example would be net income is $100,000 for your clinic. You made $1 million, you had $900,000 worth of net expenses. So now that means your bottom line, your net income is $100,000. You had $10,000 worth of interest expense. We're going to add that back. You paid $20,000 worth of taxes. You want to add that back into that. You had depreciation of $15,000, amortization of $5,000, which would put you at a total of $150,000 for EBITDA, earnings before your interest, your taxes, depreciation, and amortization. This is how your clinic would have functioned without these non-cash and tax and interest. EBITDA versus net income. So like I just said, net income includes all expenses. This is going to include any interest, taxes, depreciation, amortization. It also could have interest income for net income. But we want to look at that and say, hey, yeah, this is everything that it takes within the clinic at the end of the day. EBITDA is going to strip those items out that only focus on business operations. We don't need your taxes in there because that's not affecting your business operations. It does affect your cash flow. I understand that, but it doesn't affect the operations of the company. If you make $10,000 less, your taxes are directly related to how much you made. And it's great for comparing performance across practices or years, especially when ownership or financing changes. If you purchased a clinic 3 years ago, just as an example, and they were operating at 15% profit, and this is based on EBITDA, and you're now at a 20% EBITDA, that's a huge increase. If you purchase a practice and it was losing money, and now you're actually making money, that is a huge difference. You want to take that into account. If the last 3 years of your clinic you've seen your income go up, 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 and you feel like, hey, I have more cash, but you look at it and you're like, well, EBITDA is actually down. I'm making less now than I was, even though I feel like I have more cash. That's going to be something that this helps to level out. So what affects EBITDA in a veterinary clinic? Revenue and pricing strategy. The revenue is directly related to how much you make, and having a good pricing strategy will help you make sure you're staying competitive with the others in your industry, and also make sure you're able to live the life you really want. Payroll and staffing levels. This is something that is directly affected by EBITDA. If you have staff just sitting around, you're paying them for nothing. You aren't utilizing them. They are a huge price on the clinic. I'm not saying go out and fire your entire staff. You need them to operate. But what I am saying is the more you pay, you're going to see that's going to affect your EBITDA with the clinic. Inventory and cost controls, owner compensation and discretionary expenses, facility and equipment costs. These are all items that affect EBITDA. You would think, hey, but I need this to run. Yeah, you do. But the owner compensation, are you paying yourself too much? And that's one of the reasons your bottom line isn't as good as it should be. And you're not taking enough owner draws and taking advantage of the fact that you're not paying the self-employment taxes. That's stuff that you want to take into consideration. So adjusting EBITDA and what buyers look for. Adjusted EBITDA adds back owner-specific or one-time expenses. So any excess owner salary, we're going to add that back. If a typical doctor in your clinic should make $100,000 to be competitive, and you're paying yourself $175,000, what we want to do is say, hey, we made $100,000. We're adding back $75,000. So really, you would have made $175,000. Non-recurring legal or consulting fees. Did you bring in a consultant to make sure that your clinic is up and running well? You started implementing a new software and you paid a large corporation to set up SAP. You did this or that. These are one-time fees. Did you have a legal issue and you had to get a lawyer and it cost $30,000? Well, that's going to adjust your EBITDA if you're looking at selling. Personal vehicle or travel. Do you put all of your travel as work travel? And so, hey, we talked about the clinic one time. So it was business trip. Well, that's going to get added back in to your EBITDA. And you want to make sure that is so that you're getting the price you really should get if you decide to sell your clinic. And it's going to give a normalized view of profitability for valuation purposes. Before anyone buys your clinic, they're going to want a valuation done. Benchmarking EBITDA. A typical veterinary clinic's EBITDA margins will range from 10% to 20%. If you are an extremely high-performing clinic, you can exceed 25%, but that is an extremely high-performing clinic. If you're even close to 20%, you're going to have a higher factor when someone looks at purchasing your clinic than if you're on the low side of 10%. And it can add up to hundreds of thousands of dollars in increased revenue. The higher the EBITDA, the better. Lower margins can indicate inefficiencies or underpricing. If you're noticing that, hey, I'm really just not making what I should be, and it's because my prices aren't high enough, it's time to raise that. You work too hard and you had too much schooling to undervalue your service. Yes, sadly, there are people who get priced out of those markets. There's always low cost, no cost options. There are a lot of times you can go to a pet shelter, see if they have a way, Humane Society, but you do need to make sure you are charging what you're worth. And that's hard for a lot of people because you don't want to cut anyone out. And especially when it comes to people's pets, you have a duty and you feel ethically obligated to help them. There's also foundations you can help set up that would allow people to still come to you and you still get paid. Why should you track EBITDA as a clinic owner? One, it will help you understand the true earning power of your practice. Knowing what your practice generates before any taxes, before any depreciation can be huge. If you normally would have $100,000 in income and then all of a sudden you do your tax return, you're like, hey, I have a loss of $50,000. Why is that? Was that because of amortization? Did you have goodwill on the books? Did you have a non-compete on the books that you are amortizing over 10, 15, 20 years? Did you do a huge construction project and you now have a lot of depreciation you're taking? That's going to affect your earning power if you just look at that. It's essential if you're planning to sell, merge, or bring on partners. If you aren't optimizing EBITDA, you're leaving money on the table. You don't want to undervalue your practice and make it where, hey, I could have sold this for $1 million. Instead, I got $400,000. because you don't know how to optimize this. And it makes performance easier to compare across years and your peers. With veterinarians, you always want to know how the industry is doing as a whole. 10 to 20% EBITDA profit is a large range, but knowing that you have a range there is great because you want to strive, even if you're just dead in the middle at 15-ish percent, that is a good margin to go with. So if you have questions about your EBITDA, let's do a quick review. And you don't know how to start, just get a hold of us. You can book a call at go.hensoncpagroup.com/mistakes-calendar. You can shoot us a message. We're happy to give that to you. You'll likely have it in the email that went out on this, but if you have any questions, just get a hold of me again. I'm Joseph Henson with Henson CPA Group, and I hope you guys have a great